All right, clock has ticked over to 6 o'clock. So why don't we get started? So first of all, Happy New Year. First webinar of 2024. So I'm Mark LaMonica. I look after our content here at Morningstar, and we have 3 webinars that we're going through on Tuesday evening, same time in January. So we've got this one where we're going to talk about defining an investment strategy. We've got one on ETFs and we've got one on passive income. As always, if anyone has any questions, you can email me. My email address is just mark.lamonica1@morningstar.com. And also, before we get started, anything you hear today is general advice. I obviously don't know anything about you. I can't offer personal advice, but welcome any questions. So at any point, throw questions into the chat or into the question area, and I will get to those. So anyway, thank you guys for joining. I have the chat disabled apparently. I figured it out. Okay, so the chat should work now. So all right, let's get started. So we're going to talk about defining an investment strategy. So obviously we're entering a new year. People are interested in their finances, resolutions. Most people don't give up their resolution for a couple more days. So I want to start with sort of the foundational look at investment strategy. So first of all, where does this fall within the investment process? So very simply, I've done a lot of webinars on goals. So anyone who hasn't attended those or hasn't read some of the articles we produced around goals, shoot me an email. I can send on recordings of that and a recent guide we put out. But really, when we talk about the overall investment process, we kind of see it as 3 distinct steps at Morningstar. And I will say down at this bottom of this page, selecting investments, that's what people tend to jump to. One, because I think that's what people think investing is all about. It's obviously picking individual investments. I would say that is a portion of what investing is all about. And some may argue that is the, I guess, fun part of investing, going out there and finding a share, an ETF, or a fund, or anything else you want to invest in and actually buy it. But we really think there's 2 foundational steps that you need to go through. So as I said, goals. And the assumption today as we go through this investment strategy, someone has gone through that goal setting process. And very simply, it's defining your goal. So there's a simple goal. I want $1 million in my portfolio in 15 years. It's figuring out the return that you need in order to achieve that goal. And that involves thinking about how much money, of course, you can save, means looking at how much money you actually have now. So calculate your required rate of return. Now I can say I need a 7% return. And this is accurate, by the way, from my current portfolio of $250,000. If I save $1,000 a month for 15 years, that will get me to my goal of $1 million. And then kind of a high-level asset allocation. We'll spend some time talking about asset allocation today, so I won't go too much into it. But high level, what do you want to invest in? Growth assets. Growth assets are things like shares. Typically have more volatility. They bounce around more in price, but they do have higher returns over the long term. And then defensive assets, things like cash and fixed interest, term deposits, all of that, typically less volatility, although the last couple of years have been pretty wild in the bond market, and lower expected returns over the long term. And once you've established that foundation, that's really about you and thinking about what you are trying to accomplish. We are all investing for a reason. Well, I think there are some people that find it is an intellectual challenge. We're all investing for a reason. That's to accomplish a goal. Typically, it is saving and investing now so that you can spend money in the future. And then we get into the investment strategy. That's what we're going to talk about today. This red, I assume, box. I'm colorblind, so cut me some slack. But I assume this is red. And we're going to go through each one of these 5 steps. So we'll go through those in detail. But before we get into it, of course, we want to talk about why you need an investment strategy. And really what an investment strategy is a plan, right? So we know where we want to get. That is our goal. We obviously know where we are. As part of that goal definition process, we've evaluated how much we have in our portfolio now, which could be zero, could be a lot. We've come up with a bit of a budget, so we know how much we can save and contribute to that portfolio, but we need a plan to get there. And a lot of investors don't bother to define a goal, so they don't really know where they want to get. Or that goal is very nebulous. I want to be rich. I want a comfortable retirement. Well, that's fine. You got to spend some time defining what that is. And then don't bother to come up with a strategy and think, oh, I'll just pick the best investments. And we're going to talk today about why a strategy is so important. And we have to understand that a lot of investment decisions are, and I see a couple of people are asking for the presentation. You can get a copy of the presentation, but you do have to email me. So I'm all alone here, so I can't take down names. I don't know your email address anyway. So send an email to mark.lamonica1@morningstar.com, and I'll send along the slides. So why do we need investment decisions? Well, our goals are driven by emotions. And at a high level, those emotions fall into two different buckets. So it's greed and fear. And I think when I say that to people, a lot of people think, oh, I'm not greedy. I'm not scared of what's going on in the market. But greed can cover all sorts of different scenarios. And greed can simply be looking at an investment that has performed very, very well in the past, having some remorse that maybe you weren't invested in that and chasing that performance. Greed can be hearing about a friend or family member or neighbor, or just something you read online about someone who has made a lot of money in the share market and trying to replicate that. All of that falls within that greed category. And then, of course, fear is the fear that happens when markets drop and there's volatility in the markets. And that fear is also something that drives people to pull out of the market. And that fear can come from market drops. That fear can come from simply reading any of the media about all the horrible things that are happening in the world and all the ways that we are all basically in trouble because of different wars that are going on, geopolitical tension, political issues. All of that fear causes people to decide, even if they're not hiding under their bed, can decide maybe now's not the right time to invest. Maybe I'll wait until things have calmed down before I start investing. And the issue is that when we're driven by emotions, that is behavioral risk. And basically those emotions cause us to make poor decisions. And a poor decision can be something that is not actually in our best interest. It can be a decision, I guess I didn't put down there, a decision that is not thoughtful in any way, and it doesn't align to what we're trying to accomplish. And I see this all the time where people tell me that they're, a growth investor and they're long-term investors, but right now they're all in cash because they're worried about what's going on in the Middle East. And once again, that is not a rational assessment. And what we're looking for is we're trying to be as rational as possible, and being completely rational is impossible, of course, but we want to move along that spectrum to make sure that the decision making, that every part of our decision making around investing is really centered on what we're trying to accomplish and the best way to get there. And that, of course, is that plan. And so there are these three different things that we get from defining an investment strategy. One is, as I said, structured decision-making, rational decision-making. So having a plan, writing it down, referring back to it periodically, being thoughtful about that will increase our rationality. Not all the way. None of us can be perfectly rational, but it'll increase our rationality. The process that we're going to go through today, and that obviously you would need to do on your own, involves not so much work, but just being thoughtful about what you're doing and thinking more about what we're trying to accomplish, not necessarily the individual shares we're going to buy, but what we're trying to accomplish and how we can go about doing that is a really important thing to be a successful investor at the end of the day. The last thing is we are inundated with choice as investors. There are over 50,000 publicly traded shares in the world. There are new ETFs and funds and all sorts of different products that come out every day. And this can be really, really overwhelming for investors. And we'll talk about some of the implications of that later. But coming up with a plan allows you to narrow those choices. And as we go through this, I'll talk a little bit about my approach, and not because anyone should follow what I'm doing, but just I feel like using an example, a personal example, helps a little bit. So this isn't an academic exercise of defining a strategy. All right, so let's get into this. All right, so first we're going to talk about our high-level approach. Now, a lot of people think, and I have it on here, that this is obvious. But really all we're trying to do is come up with a clear statement about the type of portfolio that we're trying to create. And this is very much intertwined with our goals. So as I said, in many cases, you have people come out and say, oh, I'm a long-term investor, and yet they're just trading all the time. Or I really want to generate passive income, but then they're buying Bitcoin because they saw somebody did really well in it. There's some new biotech startup that they're buying that doesn't pay a dividend because they think they're going to strike it rich. Well, that's misalignment between your actions and what you're trying to accomplish. And, some investors will carve out part of their portfolio to take chances, and, that's fine, but that should be part of your plan. So yeah, concise declarative statement that's tied to your goal. So very simple. In my non-retirement accounts, my goal is to build passive income. And I do have a target. So during the goal presentation, or during the goal definition process, I did define sort of what I want that passive income to be and when I want to do it. And so very simply, to achieve my goal, I want to purchase income producing assets that provide stable income, but also a growing income stream. Because I want not only new money I put into the market to grow my income, but I want the investments that I hold, whether that's an individual share or an ETF, I want those dividend streams to grow, because that, of course, will turbocharge that growth. And I think that's necessary for me to achieve my goal. So very simple. And yes, this does seem obvious, but we'll see how this kind of ties in as we go through the rest of the process. All right, let's talk about asset allocation for a second. Sorry, this slide is very text heavy and busy, but asset allocation simply refers to how I will allocate the money I have in my portfolio into different categories. And it's really important to include in the goal setting process because, as I said, at a high level, growth and defensive assets have different risk and return profiles. And if I need a certain return to achieve my goal, and I invest 100% in defensive assets that are never going to get me that return, well, that's an example of poor asset allocation. And asset allocation is the largest driver at a high level of returns, right? So if I invest over the long term in the share market versus keeping money allocated under my mattress and not earning any return, well, I'm going to grow my portfolio more in the share market. And so it is really, really important to understand how much this actually drives returns. We're going to talk about diversification a little bit later, but asset allocation and diversification are different. So deciding I want to allocate a certain amount of money to either a broad category or underlying asset classes is very different. So if I say I want to allocate 40% of my money to Aussie equities, that doesn't mean I'm going to put it all in one share, right? Then I want to diversify. And we'll talk about diversification and what that purpose is. A decision that investors need to make is how complex you want to make your asset allocation. So at a simplistic level, it's looking at growth versus defensive. But we can layer in a lot of complexity if we want. And this, once again, should tie into what we're trying to accomplish. So we can use different asset classes. So instead of saying I want growth and defensive and the percentages in each, I can say I want to allocate a certain amount to domestic shares. I want to allocate a certain amount to global shares, infrastructure, listed property, et cetera. And we can even go a category down within all of that. So I use a couple examples like, within my domestic share portfolio, I can buy large cap shares, big companies, or small cap shares, small companies. In my international, I can buy developed markets. I can buy individual countries. I want to invest in British equities or US equities. I can invest in emerging market equities. There's a ton of different categories for bonds as well, high yield or junk bonds, government bonds, corporate bonds. So we can get very, very complex with the asset allocation. But a really important rule of thumb is that we hear all the time, we hear about why you need all these different asset classes. And a lot of that argument is coming from sort of self-interested parties who perhaps are an emerging market manager, right? I always make jokes about our conference that the emerging market manager will never stand up at our conference and say, you know what, now's a really bad time to invest in emerging markets, right? If that's what you do for a living, then yeah, exactly. So Daniel just said that. Yeah, if you were an emerging market analyst or portfolio manager, you're never going to get up there and say it's a bad time, right? So we have to think about what we are trying to achieve and how it is helping us achieve our goals by getting more complex with our asset allocation. And that doesn't mean that if you take a simplistic approach that you can't invest in those types of assets. So a very simple example is, and we're going to set criteria later for picking assets. Very simple example, which we'll kind of go through, is if I'm looking to generate income from my portfolio, I can get very specific with the types of companies or ETFs I want to buy. And if emerging markets happens to be really attractive, if I think those are stable and growing dividends, I could go buy emerging market shares. I could go, and we'll talk about diversification, I could go buy Aussie shares, global shares, I could buy fixed interest. So all of that can still be done. The question is, when you're defining the asset allocation, which is going to set basically a range that you want to allocate to each one of those asset classes, the more complex you make it, of course, the harder it is to maintain your portfolio when we're going into things like rebalancing and stuff like that. So simplistic is not wrong. I think that the investment industry throws so much jargon out there and tries to make things seem so complex. Seems like you're an idiot if you don't have a allocation to, Peruvian equities. So yeah, something to think about. And there are some questions coming through, which I'll get to in a second. But my asset allocation is simplistic. 90% of my assets, so I never changed it after that goals. Period. 9% of my assets in growth, 10% in defensive. And that allows me, using my security selection criteria, to make some changes. All right, we've got a good question from Paul. So he says, don't we all have the same goal, a reasonable amount of money when we retire? The only variable is a risk profile. What are examples of more tangible goals? Okay, well, a couple of things. So first of all, reasonable is, of course, up to all of us. A reasonable retirement for one person may require a portfolio of $500,000 in it. A reasonable portfolio for someone else could be $10 million. There are different return objectives that are inherent when we're looking at how much money we have and how much money we need. So that's one thing. The other thing, and yes, how long you have to go until retirement is also a big factor. The other thing is, people certainly have goals that are not associated with retirement. There can be goals, and certainly this income goal, I specify non-retirement accounts. And really, my goal from the income I want to generate, and based on my own personal circumstances, is I want to start spending it before I'm retired. I want to spend that money doing things like traveling, and I want to try to enhance my life from passive income. So that's an example of a non-retirement goal. Now, that will obviously, knock on wood, flow into retirement, but that is a goal that I have that is a little bit different. And Doug just put in a message. Yeah, retiring early is very different than a traditional retirement. Obviously, you can't rely on super if you're trying to retire early. There are all sorts of different considerations. So yeah, I think people can have, well, retirement is a common goal. People can also have other goals. I want to buy a boat in 20 years. I want to buy a second home in 20 years. So people have all sorts of different goals. And it might just be trying to amass a certain amount of money that can then be immediately spent. So if you have a longer term, obviously, if you're trying to buy a house next year, I wouldn't invest it all in the stock market or probably any of it in the stock market. But if you want to buy a house in 10 years, then yes, that goal, that amount of money, that has nothing to do with retirement, and that price you have that you envision paying for that house, that can go into a goal. All right, we're going to talk about edge. So I talk about it a fair amount, but maybe it's a term that you're not familiar with. But edge is, once again, a little bit of a jargony term that looks at what your competitive advantage is as an investor. And this will matter in a little bit, trust me, but there are really 4 sources of edge. And when we think out what's happening right now, right, or what's happening always in investing, you are in a way competing with people, or maybe you decide not to compete with people and you decide that you're a passive investor and you just want to buy the market because you don't have edge. But let me go through these 4 different sources. It will inform the types of securities you buy, and it will inform the process that you go through to invest. So first of all, there's informational edge. Pretty simple one. It means that you know something that somebody else doesn't. Now, informational edge is very, very difficult to come by these days. First of all, there are a lot of laws that require companies to fairly disclose information so that some investors don't know things that other investors do. So there's a lot of there's a lot of information around that. Obviously, the internet and the ability to disseminate information widely is also something that has broken this down. In the past, it was just if you lived close to an exchange or maybe you knew some people, you could get information before them. Really, what informational edge is now is a lot of it is insider trading, as somebody made a comment. So that is kind of deliberately going out there and getting information. You might have informational edge in other ways if perhaps you work for a company, but most of that's actually blocked as well. Analytical edge. And I'll get to Lisa's comment in a second. So analytical edge means you have the same information as everyone else, but your ability to analyze it is better than other investors. Now, there's a couple ways this could happen. So Lisa just made a comment that, a mining expert, which will allow you to interpret publicly available information better than other people. So expertise in a certain field is certainly a case of analytical edge. Analytical edge is also when we think about how we evaluate securities, certainly how professionals evaluate securities. We're trying to figure out what's going to happen in the future. So some people are better at that than others. So you could have analytical edge. Remember, this is hard. And it's hard because you are competing against a lot of highly educated, very experienced, very well-resourced investors who are generally professional investors who are generally paid very well to work very hard and spend a lot of time doing this. So if you are out there trying to come up with an analytical edge over all of these professional investors, and you're just someone who's working another job and kind of doing this for a couple hours a week, that can be very hard. Does not mean it's impossible, but just something to remember. That is very hard, and you're competing against the whole market. So I put half-wit neighbor. Yeah, you're not, competing against a couple idiots out there. You're really competing against most of the market. And remember, if you invest in an index, you are getting the average. So you need to be better than average at this to have an analytical edge. 2 other edges which I think that anyone can have. Doesn't mean it doesn't take a little work. So one is behavioral edge. So we talked about one of the reasons that we want to put together an investment strategy is to cut down on those behavioral mistakes. And if you are able to do that, and you can do that through structure, you can do that through discipline. I think you can do that through education and really understanding all of these biases that are out there that are impacting our ability to make rational and good decisions. This is a source of edge that you can have over other investors. And a lot of it really starts with this: documenting your goals, your investment approach. Structural edge. So while I said there's a lot of advantage that professional investors have, there are also a lot of disadvantages that professional investors have. So as an individual, having structural edge is a real possibility. So structure basically refers to all these external factors that influence the way, particularly professional investors act. One is that professional investors, of course, are highly paid, as I said, which gives them a lot of incentive to not lose their jobs. And generally speaking, doing what everyone else does is going to help you keep your job. Going out on a limb, either making a very different asset allocation than the rest of the market, investing in securities that are not very popular, well, that can be a huge problem if you do not do well. The other thing that really influences financial professionals is, well, all of them will sit there and say they're long-term. Very few are. And the reason I know this is, of course, you can go in and look at the data of portfolio turnover, how much they're trading their portfolios. They are not long-term investors. And the reason for that is because we make lots of stupid behavioral risk influences the way we invest. If a professional investor underperforms for even a short amount of time, then all of a sudden they're going to find themselves in a situation where they're going to see outflows. That means their company is not making money. So that's why we see a lot of sort of closet indexing. That's why we see a lot of sort of short-term trading, looking for catalysts that are going to move a share over the short term. And really the way, and I did see that in the chat, really the way that we overcome this is we can be long-term investors. And that's a good comment also, Daniel, that they're paid to do stuff, right? Like if you're sitting around all day and you're supposed to be doing something, right? Like, you have Warren Buffett who just sits around all day and reads annual reports apparently and doesn't trade that frequently. Okay, well, that's fine for him. But for a lot of investors, and for a lot of individuals, we think that like action is something that we should be doing. We should be responding to the markets. So holding things for the long term is a very easy way for us to have structural edge. And I did see a question coming through saying, what length of time do you consider to be a long-term investment? Well, listen, that depends. A long-term investor, first of all, and to get structural edge is not just saying you're a long-term investor, it's acting like it. So a long-term investor, let's say, hey, whatever time period it is, whether it's 5 years, 10 years, something like that. But really what we're looking for is holding periods now of things that are in your portfolio. And even if you say you're a long-term investor, you can trade all the time. It's really looking at those holding periods, and forget the exact numbers, but as the barriers to trading have come down, right? Now you can sit there and trade on your phone while you're walking to lunch. As those barriers have come down, we've all started trading more. And the average holding period, I think right now of a share on the New York Stock Exchange, which I think was part of the study, is something like 5 months, which is like shockingly short. And if you go back to the 1960s, I believe it was 8 years. And so there's been this huge drop in the amount of time that people are holding shares, are constantly churning their portfolio because it's gotten cheaper to trade. You can do it on your phone. Think about if you go back even 20, 25 years, you just have to call your broker. And at least that's an impediment. It's somebody that can talk you out of it. So yeah, it's sort of remarkable how short-term trading is taking over. And it's also this abundance of choice. And the fact that you're constantly getting data and marketing from all these different ETF providers and everything else. So I think that I have behavioral and structural edge. So basically means I do not think that I have any other sources of edge. And I think kind of the ways to do this are focusing on finding great companies, that have long-term competitive advantages and letting them play out. And that's very different than sort of a catalyst-driven investor. Catalyst-driven investor, which a lot of professionals are, is okay, what is going to move this share price in the next 5 months? Taking that long-term mentality is, well, forget that. I am just going to find a great company knowing that if my thesis is right, that, and I hold it for a very long time, all those advantages will accrue to me as an investor. So yeah, you can sort of read through the rest of it, but this is very much tied to my overall high level approach, right? That I want to generate passive income. And, I've heard all these little dividend strategies where I buy something right before the dividend and then I sell it and then I do all sorts of different things. Well, I just want to find a company that I think will grow a dividend over the long term. Doesn't mean I'm always going to do it, and take advantage of that compounding, right? You hear all these people talking about compounding and how important it is, and then they trade all the time. Now, one very important point to make is if I've gone through this list and all of a sudden you say, well, I don't think I have any of that, that is okay, right? So what that means is that if you don't believe you have the ability to have information someone else does, analyze that information better, if you're worried about behavioral risk, constantly switching your portfolio into like better investments, become a passive investor, like truly a passive investor, not this passive investing where we're like constantly trading and adjusting asset allocation. Go out there and buy the market and just hold it and say, put your plan, no matter what happens, every month, every 6 months, whatever it is, I'm going to invest a certain amount of money. It's an enormously successful way historically to invest. And it's what Buffett says that most people should do. It's not what he does, but he's a little special. But it's what he says most people should do. It's certainly what John Bogle, the founder of Vanguard, talked about. So if you don't think you have any sources of edge, fine, buy the whole market and just sit back and continually put money in. And there are some behavioral things you need to work on and not panic or switch those investments. But yeah, that's easy. It's not easy, but it's certainly possible. All right, so now we're going to get into security selection criteria. So this is certainly a little more complex. Now, why do we want to do this? As I said, there's an abundance of choice out there for investors. And if we know that investors typically trade too much, we need to really focus on, okay, how do we narrow down that universe of all those securities? How do we then go in there and make sure that we have some structure around the decisions that we're making, and we're not just buying something because our neighbor's son found this great share? How do we not chase performance? And, and this really, like, this abundance of choice with all the marketing and everything else that goes on, and both direct marketing and also marketing in terms of you pick up the AFR every day and read about, I don't know, today was this portfolio manager loves all these different shares, and Morningstar does this too. So I'm not going out there just blaming other people, but that can either paralyze you because you don't know what to do. And that can happen to very unsophisticated investors or very sophisticated investors that find something wrong with every single thing that's out there. Or it can mean you're constantly switching. You read something compelling about a company and, I need to invest in that company. What do? Well, you go sell something, buy this new company. And then 3 months later, you find this other really compelling opportunity. So what we want to do is we want to go through 3 different steps of the process. The first is looking at your sources of edge and how you're actually going to take advantage of that edge. So it's kind of really the simple example that I said that, okay, it's easy to sit there and say active versus passive. What are you going to do? Well, active can be you actively going out doing things. Active can be taking a very different asset allocation and switching that asset allocation based on when you think things are attractive. And that can happen both with active and passive. But do you think you're able to identify securities better than somebody else? Do you think you're able to hold them for the long term? Once again, if you don't think you're able to do all of that stuff, then maybe passive and never changing the asset mix in your portfolio is the right approach. We need to look at personal circumstances. Now, personal circumstances could influence your investing in all sorts of ways. One, it could just be simply where you live and what markets you have access to. So there are certainly markets out there that you can't trade individual shares in, or you can't do it in any way, in any easy way. So that's sort of limiting your choice. So that means if I want exposure to those markets, I need to find a professional to do it, or I need to find an ETF that will do it. I can't trade individual shares. There can be personal circumstances around funds versus ETFs. So one of the advantages of funds, and I know people don't love funds these days, but one of the advantages of funds is that you don't have to incur trading costs every single time you invest in something. That can be a personal circumstance. If you set up a savings plan with the fund, you can continue to put money into it. A personal circumstance could be that trading foreign shares, if you don't have a big portfolio, if you want to directly trade foreign shares, can be very expensive. So the transaction costs are generally higher, or they like really get you on the FX, switching your money into that. So these can be personal circumstances that influence what you're going to buy. So just go through there. And what we're trying to come out of this, these first two steps, is saying, okay, I invest in individual shares. It can be different in different countries. I invest in individual shares in my domestic, allocation, and ETFs, because I think those vehicles are best for me. Globally, I'm going to use an active fund manager because I think that's best. So it's really looking at each one of those categories, what your investment selection criteria. And then we want to think about how we evaluate securities, right? So you've decided, and I'll go through a sort of long example, my own personal example. You've decided you want to buy shares. How do you figure out which share to buy? And what we're looking at here is not necessarily comparing two different companies. It's really eliminating large parts of the market. So let me go through mine, because I think this is a good one for example. Sorry, the font's a little small on this. Okay, so I'm interested in generating a sustainable and growing income stream. We know that because that's my high-level approach. So what does that mean? Number one thing is I want income, right? So I want the things in my portfolio to generate income. So very simply, that allows me to eliminate anything that doesn't generate income. So no matter how compelling the case is for me to go invest in this tiny startup biotech firm, if it doesn't pay a dividend, and there's certainly no prospect in the near term of it paying a dividend, I will ignore it, right? So that's an easy one. Same thing with an ETF. That ETF does not hold income-producing securities, doesn't hold dividend-paying funds. If I'm not getting that distribution, not just the capital gains, getting that distribution from dividends, I won't buy it. I won't buy Bitcoin. And, I could sit up here and come up with 50 reasons why Bitcoin's bad. I'm sure Will, our podcast producer, if he came in here, he'd come up with 50 reasons Bitcoin is good, but I won't buy Bitcoin because I want the assets that I hold to generate income. Bitcoin doesn't generate any income. So very simply, allows me to eliminate large parts of the market. Sustainable. So I want a sustainable dividend. So what does that mean? It means that I want to limit or eliminate, if it was a perfect world, dividend cuts for my portfolio. And there's a lot of implications that it has. And I'll go through these very quickly. Cyclical companies, so companies that follow the business cycle, right? So they tend to not have sustainable, stable income. The reason is because if they are, especially a lot of companies in Australia have this policy, it's a little different in the US, where they'll pay out, let's say 70% of earnings in dividends. So if you're going out there and buying a highly cyclical company, you're going to have big swings in dividends. And that might be perfectly fine for somebody. I'm not saying that's a good or bad thing, but because I want to spend this income, I don't want that. Could be the same thing if you're in retirement, trying to generate income out of your portfolio. You don't want to sit there and like BHP, for example, which has paid strong dividends lately, but there's been a lot of periods where the dividends have gone down significantly. If BHP deciding to maintain their dividend, cut their dividend, grow their dividend is going to influence whether you are going on vacation next year or not. Maybe you don't want that in your portfolio. So I don't want cyclical companies. I want companies that have moats. So a moat, certainly it's a Morningstar rating, but conceptually a moat is a sustainable competitive advantage. I don't want competitive things that happen in the market. I want my company to be able to withstand that competition and the bad impacts of competition. So that's really important. I want companies with low business risk. So different types of companies have different levels of business risk. So very simply, and I know I've gone through this stuff in the past, a large global company has less business risk than a small local biotech company that's reliant on the economy in a single market, potentially reliant on a single product that may not even be approved yet, that's still being researched, is very different than a company that sells lots of things in lots of places. Those big companies probably have more financial strength. The ability to go access funds. So if something goes wrong, they can go out there and borrow money, keep the company going. And that kind of goes into the next one, right? I want companies that are in strong financial position, because all of that will influence their ability to pay dividends. I want to look at the payout rate. Yeah, healthy balance sheet, exactly, Doug. I want to look at the payout rate. Healthy balance sheet, I also say, to generate a lot of cash. Right? That's something I'm looking for as well. Payout rates. Payout rate is a percentage of earnings that are paid out in dividends. So very simply, if a company pays out 99% of their earnings in dividends, it means any fluctuation in those earnings could cause a dividend cut. So the lower that payout rate is, and there's a trade-off, of course, with the size of the dividend, but the lower that payout rate is, the safer that dividend is. All right. Growth. And here's the other problem. I also want these dividends to grow. So generating a high level of income and generating a growing level of income can be difficult. And it's really about trade-offs. But how do companies grow dividends? Well, they need to grow earnings. I need companies that have good prospects for growing earnings. And it's, of course, as I say in here, it's impossible to predict the future, but companies that have moats or sustainable competitive advantages, that can influence them, because of course it allows them to hold competition at bay. But I want that growth. Now, some of these are conflicting, right? Because a lot of growth companies that are going to be able to grow their dividend in the future are companies that pay lower levels of dividends right now. But remember, this is creating an entire portfolio of these companies. And I can have some trade-offs. I can pick some companies that pay higher dividends and potentially have lower growth. I can pick some companies that I think will grow faster, lower dividends. It's really what I'm looking for is the average for my portfolio. So I don't invest in actively managed products in both funds and ETFs. So that's one influence that sort of this goes through. And the reason, well, I mean, there's sort of lots of reasons for that, but one thing that takes away from my earnings or my dividends is paying a higher management fee, which you often get. There are factor ETFs, right? They track dividends. So a factor ETF is an ETF where the holdings and the decisions made are based on a set of rules. I can go in there and evaluate those rules. So there are certainly lots of opportunities for me to go out there, so I can sort of ignore active. And that's just a choice I made. Doesn't mean it's a right or wrong choice, but yeah, once again, just trying to be honest here. I'm going to pause for a second. We've got some questions. All right. So Zara says, I have a problem in selling when my stock is well moving upwards beyond fair value, although I know I should take the profit. It's a great company. When do I sell? I hold way too long. Mark, could you speak to when to sell? Yeah, it's kind of a whole other topic. What I would say is, and I've written an article on this, Zara, if you send me, literally, it's called When to Sell Shares. Send me an email, I can send you the article. But just remember, I don't necessarily consider a share that goes above fair value. If I'm looking very long term, I don't see that as a reason to sell because there are some consequences with selling. One, obviously there are tax consequences. Two, it assumes that I'm going to be able to take that money and invest it in something better. So while you certainly should not expect anything you own to go straight up, you're going to realize there's going to be some of those dips. What I'm looking for is if I go out a decade, I want to see what those returns are. We're actually recording a podcast episode on Thursday, which will be out Sunday on this as well, going through a couple of examples in my portfolio. So yeah, don't feel like, there's going to be volatility in everything. And if you're a very long-term investor, there could be years where one of your holdings, one of these great companies, is not going to do that well. And you have to be okay with that. Remember, that's your structural edge, that you're not worried about beating the market every year. Nothing bad's going to happen to you if you don't beat the market this year. You're trying to achieve your goal over 10 years and finding the right companies for that. So Stuart says, is it reasonable to have a goal to outperform an index, the ASX 200 accumulation index, by a given percentage a year? It takes out external factors affecting the market. Strategy cannot outperform the index and be sensible, just invest in ETF. Okay, so that is the way that professional investors invest. I think two things about that, Stuart. One thing is that what happens if you don't outperform it in a single year? Does it really matter? Are you a failure? You can have a goal that I want to, because I'm picking individual shares, not the index. If your goal is a certain return base, you can say, I want to outperform over the long term. I think the problem is if you set that on a yearly basis, and I look at this, I used to look at this more, but I look at this just because I'm curious, but I'm not letting it drive decision making. So what you don't want to do is have a bad year and panic. The other thing that I would say is if I'm a fund manager and the market goes down 40% and my portfolio goes down 30%, I'm celebrating, right? That's a great accomplishment. I've outperformed the index. That can be a huge problem for you as an investor if you're trying to retire that year, for example. And so I think it's very important for the goal to be where you want to get, not the goal of just outperforming the index. I think it can be an interesting thing to look at, but the goal is where you want to get. So if I want to retire next year and my portfolio goes down 30%, I might not be able to. So that's why the goal is sort of the destination. Then we want to come up with a plan, a strategy to try to get there. So maybe your goal, and I think this would be a hard one to achieve personally, but maybe your goal is to go back historically and you say the market's return 10% a year. Well, I'm going to beat it. I'm going to get a 13% return over the long term in my portfolio and try to come up with a strategy to do that. I think that's fine if that 13% ties to something very tangible like that. I need $1 million in a certain amount of time. So yeah, just a couple thoughts on that. So Lisa says, how do I do the math? How do I calculate how much income my investments will potentially provide in the future? Yeah, so what you want to do is you want to look at your overall portfolio. And there's a couple different ways that you can do this. Let's say you're a passive investor. You can sort of go through and say, what do I expect this index to generate over the future? Like, if you take an index that, let's say, yields 4%, and you need $40,000 a year in income. Well, pretty simple. Okay, I need to get $1 million into that portfolio. Now, that's going to fluctuate over time. So that's one thing. Really, the way that I've done it is I've looked at how much income do I want to generate and how much do I currently have and what do I need to grow it to get there? So if I sit there and say, okay, I need 7% income growth, I can start breaking down those components. How do I get to that 7% growth every single year? Well, one way is I invest more. Right? So when the yield's actually high, when the market goes down, the dividend yield goes up, I'll just invest more money. It will encourage me to do good things. So that's one thing that I would think about. So that's one component, investing new money. The other is dividend growth. So I can start sitting there and saying, okay, if I need to get to a certain point, part of it is dividend growth. Part of it is, of course, dividend reinvestments. You can sort of break down those different components to try to get to that goal. So I'd start with the goal. How much income do you want to generate and when? All right, I might skip that question for now. I'll get to it at the end. Let me keep going, and I'll stay on because it's Tuesday and I have no life. So I'll stay on and answer the rest of the questions. Just want to get through the next slide. Okay, the last one, establish the basis for making changes to your portfolio. So remember, one of the things that we run into as investors is people overtrade, and there's a lot of bad consequences. We chase performance. The things we buy tend to do worse than the things that we sell to buy them. There's all sorts of studies. All this sort of behavioral risk getting driven by fear and greed and everything else. We've got a Mind the Gap study at Morningstar that shows over the long term, investors underperform the investments they buy by 1.7% a year, which basically means they're making very bad timing decisions. So we want a lot of structure around making changes to our portfolio. So we just had our structure around security selection. What are the things we're going to look for? What are the attributes we're going to look for? Now we want structure around making changes to our portfolio. All right, so there's three broad categories that I put them into why you would want to change your portfolio. First one, rebalancing. You can rebalance on two different levels. One, it can be asset allocation. So I want 40% in equities. The market's done really well. Now I have 60% in equities. Well, that's not great. So that's rebalancing. Trying to get that back in the line, lower your risk profile in that perspective. The other can be diversification. If a certain position is grown to be too big of your portfolio. Now, you can define what that is. I'll talk a little bit about that in a second. Remember, and I got an email about this the other day, saying like, how much is too much? And somebody actually sent me an example of this position that's done very well that makes up a huge amount of this gentleman's self-managed super fund. And, you know, there is no real rule of thumb of how much should go into an individual position. Remember, with diversification, we're trying to eliminate single security risk or reduce single security risk in our portfolio. But really the way that I think is more intuitive to think about it is what would happen if this giant position went to zero? What would happen if it fell 20%? What would happen if it fell 50%? What would happen if it went to zero? Those things do happen, right? You know, Enron's the famous example that like the day Enron went bankrupt, you know, there's something like, you know, 9 out of 11 analysts had buy ratings on the shares. That was obviously a case of fraud, but these things do happen. You are removed from these companies. There is fraud. There is just stupid management decision making. There are external factors like COVID that put companies out of business. So think about the implications on achieving your goal if there were large drops in these giant positions. And if you get to the point where you think, if this thing dropped 20, 50 to zero, you're never going to achieve your goal, then you're not diversified enough. The next one is the investment no longer meets the original thesis. Remember, we define security selection criteria here. What do I want? I want companies that grow dividends, that grow dividends, have stable dividends, earn me income. I want to do that by finding companies with moats and low business risk and low payout rates. And so I have all this criteria that I use to select those companies. And what's really helpful is if you actually jot this down, does not need to be, you know, War and Peace here, but just say, why did you buy this? Why did you buy this security? Well, I bought it because I believe it has a moat. I believe it's low business risk. I believe it's in good financial shape, et cetera. Go through those check boxes. And if something changes on there, then that's a good reason to sell it. So what that means is this security is no longer meeting my criteria. Not the way many people approach this, being like, oh, God, the security didn't do well. Like, it's had bad performance. This other thing is had better performance. I'll sell the bad performance and buy the other one. It's the way we think long term. Think about the thesis. Things cannot do well for all sorts of different factors, but does it still fit that criteria? So if that thesis changes, of course, it's a reason to sell. A change in investor circumstances. So the very simple one, we're talking a lot about retirement. A lot of investors, as you approach retirement, want to lower the volatility in your portfolio. That means you need to sell growth assets and buy more defensive assets. But remember, that's based on your circumstances changing. It is not based on the market changing or your feelings about the market changing. It's based on your circumstances. This better opportunity question is why a lot of people sell. And we have to be very careful because, of course, people spend a lot of time on trying to find or spend a lot of time promoting certain investments. So things can sound very good. You have to be correct that it's actually better. This is the very dangerous one, why people sell. It's because you think something is a better opportunity cost, right? Just be careful around this one. It assumes, and go back to that edge, right? How do you know that the one thing that you're buying is better than the thing that you're selling? Well, it basically means that you have analytical edge or informational edge, right? You are better able to evaluate the investment you have and the investment you don't have. If you don't think you have that source of edge, then you probably shouldn't be doing this. All right. So finally, what's my criteria? So 5% is my criteria. I don't want a single share. Now, ETFs I'll allow more because remember they're diversified. I don't want a single share to make up more than 5% of my portfolio, both on a market value and an income basis. In terms of like the allocation to growth and defensive, like mine's pretty simple. My defensive assets are cash. So it's like very easy for me. I don't have to sell anything, right? You don't have to sell anything with cash. So I don't have to have any of those poor tax consequences and things like that. I try to avoid selling ever, even from rebalancing. And the way that you can do that is what happens if a position becomes larger, is approaching or becomes larger than 5%. Well, there's a couple of things I can do. I can turn off a dividend reinvestment. I can direct my savings into other investments, right? I leave that amount a little bit. If you are in retirement and you're trying to sell off your portfolio, well, if some position gets too big, well, that's the one you can sell, right? That's another way you can reduce it. So I don't ever want to sell. I'm not in retirement. I'm not trying to liquidate, but think of ways that you can rebalance your portfolio without selling something and buying something else, if at all possible. And yeah, obviously this thesis is the big one for me. All right. So I made it through the slides. So somebody asked, I'm sorry, I'll go through the questions now and stick around for a little bit. If anyone's interested, I'm putting my email into the chat now. There was a question. I did see a question around moat. How do you calculate a moat? How do you obtain this information? That is probably a whole nother webinar. So if you send me an email, I'll send you some information. And really, the information, and I've done webinars on them as well, so I can send you a copy of that, a recording of that webinar. So really, like, did my email not go through? That mark.lamonica1@morningstar.com. Oh no. Okay. I see what's happened. Everyone. All right, let me send that again. Sorry about that. So send me the question about moats. It would just take a little bit for me. Sorry, I'm trying to multitask here by writing my email. There it is. Everyone should see that. Send me that question about moats. Let me see, and I'll answer some of the questions you have. So if you have any, send them through. Okay, here's this one that I skipped before. This is from the anonymous attendee. It's not the current topic, but when I first saw buy and hold investing, I thought of it like the diamond hands trend from Reddit, where you just hold forever, no matter what happens. I've seen a comment apparently made from Warren Buffett about how he prefers to hold forever. Does this really mean to never sell? Rebalancing? No, so it doesn't mean to never sell. So, Warren Buffett says that his preferred holding period is forever. And he has a bunch of quotes around that. Where he talks about, you invest like the share market, which is just for transactions, closed for 10 years. So that's sort of that quote. The diamond hands thing is like very different, right? The diamond hands thing, this Reddit trend is it's this whole hedge funds are trying to screw little investors by shorting a stock. And so, yeah, don't sell because you're going to screw the hedge funds. And remember, when somebody on Reddit is telling you to do something and you have no idea what position they have, how this benefits them. Of course, anything that I own, I don't want anyone to sell it because the only way it goes down in price is if people sell it. So yeah, very different concepts on there. So June says, we pick a great share to hold for the long term for income. Gave a couple examples, and then private companies come in, take them over, and privatize them, and you're forced to sell. Triggers capital gains we don't want. We want income for something in a super fund. Then you have to replace them. Yeah, I've been very annoyed about that as well. So a lot of things that I've held have been purchased by private equity, which is very annoying. So fortunately, there's not much you can do about that, but I feel your pain. So we got a question: are the Morningstar ratings, screener rating, and the stock rating different? Talking about short trading platform. What do they mean? Normally, I go for the stock rating. Okay, so this is sort of the 30-second answer is quantitative ratings and qualitative ratings that Morningstar generates are different. Quantitative are done by algorithms, so basically a computer. Qualitative are done by our analysts. I'd certainly recommend our analyst ratings. And the reason I'd recommend them is, when we go through this process of defining our criteria, part of it is understanding the company, right? So we obviously have all these different ratings at Morningstar, but, the thing that I find most valuable, yes, they could be potentially a little clearer, but is reading our analyst report, describing the company. So you understand the industry they're operating in, you understand the competitive forces, you understand their strategy, you understand why, whether you agree with it or not, why our analyst thinks there's a moat. You don't have to agree with what they say, but it's really the information that I think is really important. And sorry, guys, if I can't write down the email addresses because it's only me and there's nobody else monitoring this today. So if you could just email me and ask me to send whatever you want. It's just as soon as I turn off this presentation, it all disappears and there's no transcript. All right, so Rick says, what are your thoughts on portfolio construction use of the efficient frontier analysis? Do professionals utilize such an approach on a day-to-day basis? Okay, so what we're talking about with the efficient frontier is we're talking about there's this trade-off between risk and returns. So in theory, the more risk you take on, and risk is defined by volatility, more risk you take on, the more volatility you're willing to put up with, the higher return you will get. I don't believe in it, number one, because if you go back and look at, I've got an article coming out next week that goes through this on dividend investing. If you go back and you look at dividend shares, they are less volatile and have higher returns than the overall market. So that would not fit on the efficient frontier. So the people that believe in the efficient frontier and the people that practice the efficient frontier, finding out, plotting all these different assets and finding which one is closest to the efficient frontier are far smarter than I am. So take that as it is. It's very difficult for you to do that as an individual investor. You could certainly find a actively managed fund, which you probably pay a very high fee for, to have a bunch of PhDs figure out where stuff is on the efficient frontier. And it's not making fun of PhDs. My wife has a PhD, but it's in psychology, so a little bit different. But yeah, let's see if we have any other questions. Yeah, have a dwindling crowd, which I sick of hearing myself talk. Okay, so we've got a question. Do you recommend any specific time of the year for rebalancing portfolio if I'm annually rebalancing? Listen, I don't think there's necessarily a time of year. So remember with rebalancing, which I should have mentioned, you don't want to do it too much because there's naturally going to be volatility in your portfolio. So the two ways people typically approach rebalancing is they do it either at a set time frame, so maybe annually, which is this question. I don't think it necessarily matters at all the time of year. The other way that people do it is they do it based on tolerances. So if something gets 10% out of line from where I want it, then I'll sell. So yeah, that's rebalancing. But yeah, it doesn't really matter what time of year. So people tend to do it either early or late in the year, sort of around this period, because that's when people typically spend a lot of time looking at their portfolio, but it doesn't really matter as long as you're sort of consistent. Let's see, we have the moat. Yeah, we had another question about rebalancing. Okay, so we've got a good question. So if you have a time horizon of, say, 20 years and required rate of return 10%, how do you monitor and assess the performance of your portfolio, say after 5 years, 10 years, 15 years, more after an actual math behind it? Okay, so very simple. What we can do is we can constantly reevaluate that required rate of return, right? If your portfolio, if 10% is your required rate of return, your portfolio is performing under it, then of course that required rate of return is going to go up. If you're earning higher returns, your required rate of return is going to go down. So we've got a tool on Morningstar Investor that you can use to do that. You can also use any financial calculator to do it. It's not as intuitive, but we've actually got how you do that. I can tell you how to do that. So if you send me an email, I can just send you a link to, I think it's calculator.net. And there's a financial calculator that allows you basically, it's kind of the time value of money formula rearranged a little bit. So you're solving for that rate of return. But yeah, I can send that to you. It's not that intuitive because you have to put in some negative numbers. But once you know how to use a financial calculator, you can recalculate that at any time. Okay, so we have a question from King. If you bought a share and it's dropped quite a bit, at what percentage drop in price are you supposed to sell? Well, you can do whatever you want. So I wouldn't, when we start making decisions based on performance, that's a problem. It's why we want to define that criteria. And the problem that a lot of people come into, and see if that thesis has changed, right? The problem, a lot of people say, why did you buy this? I bought it because I think it's going to go up. Now, why you thought it went up, maybe you heard some portfolio manager say something great about it. It's in her portfolio. Maybe you read that lithium is going to be used in all car batteries and lithium will keep going up. If you're basing something solely on wanting it to go up, and I get that all of us want the things in our portfolio to go up, then it's going to be very hard to make decisions off of that. So what you really want to do is say, okay, like, and lithium's a good example, right? Lithium was this investor darling who has not done well. Now, a lot of people would say, including our analysts, that this was expected. But if you believe in the long-term potential for lithium, like you don't care what lithium did last year, you know that 20 years from now, you think the price will be significantly higher, then why would you sell? Like that's where it's like coming up with this thesis, understanding that a commodity is going to naturally have volatility in it, right? Like oil fell 3% last night. Saudi Arabia did something else happens in the Middle East, it could go up 10% tomorrow. Like we don't know, right? There's going to be volatility in those commodity prices. So I think that's where come up with your thesis. Why are you buying this investment in the first place? And then you can go back and check that thesis and say, okay, do I really care about that price? No, I still believe in this company for the following reasons. So we've got a question. Thank you, Marcus. Seminar available on the morning website. That's an easy one to answer. It will be, but like everyone's still on leave. So yeah, probably won't be till later next week, but we're going to start publishing them on the website. It'll also be available on YouTube. Okay, question from Gary on mostly Aussie shares. Want to invest overseas when ETFs or funds be better, cheaper, and easier? Very much depends upon the individual ETFs or funds. I would say that ETFs will be easier. Funds are, unless you use a financial advisor or want to fill out a bunch of paperwork, funds are generally very hard to access in Australia. So ETFs are easier. Cheapness is based on the individual one. Hedging. So hedging is an interesting one. So a lot of funds and ETFs that invest globally, there's a hedged version. So a hedged version removes currency risk, because remember, currency risk is going to impact returns. If you're investing in the US, how the Aussie dollar does versus the US dollar is going to impact your returns. You want the Aussie dollar to go down, by the way. If the Aussie dollar goes down against the US dollar, then your returns will go up. So if the Aussie dollar goes up, the opposite happens. There's two different ways to think about hedging. One way is, do you have a viewpoint on currency, right? The Aussie dollar has been weak kind of since COVID. Some people I've talked to have a view on currency and say, hey, it generally bounces around in these ranges. It's pretty weak. It's come up a little bit, but it's pretty weak. Now is a good time I think it'll probably go up. Now is a good time to buy a hedged ETF or fund. So that's one viewpoint. The other thing is, would this affect your goal in any way? So one way to think about this is, okay, travel. Let's say you want to retire and you want to travel overseas a lot. Well, you kind of got an offset there, right? So if the Aussie dollar goes down a lot, that's bad for you if you're traveling to the US, because all of a sudden a cup of coffee is going to cost $25. But if you invest in an ETF where it's not hedged and you're benefiting from that drop, that's a positive for you. So you can maybe think of offsets. So yeah, there's a lot of different ways to think about that. I know it's not a great answer, but yeah, without me being able to know, the simple answer is, if you know where the Aussie dollar is going, then yeah, pick one. But most of us don't over the long term, which means it's kind of a crapshoot unless there's something that we're trying to accomplish. Okay, so Terrence has a good question. I'm rewriting my ISP. Is it super proposed? Listen, I think an ISP. So listen, I think it should be as concise and clear as possible, right? You're not writing the great novel here. So I think keeping it very, very concise is a good way to do it. Make sure it's understandable. Remember, you want to be able to refer back to this, right? When you're feeling stressed about, basically ISP, investment policy statement. So I think you mean IPS, but investment policy is what we've gone through. It's your strategy. So investment policy statement is kind of like the fancy way that a professional investor would call it, but it's your strategy. It's your plan. What we've been going through today. Yeah, you want to refer back to it when you're actually stressed. So go back and look at it when you're stressed, when you're getting greedy because you hear Bitcoin's going back up or whatever it is. Go back and read it. So that's why you don't want to make this too long and complex, but really it's for you, right? At the end of the day, I think there's probably value if you have sort of an investing buddy or a family member to have somebody else read it, challenge some of your assumptions in there. Some people aren't comfortable doing that, but it's really for you. It's for you to refer back to. I think maybe all the questions are gone, which is exciting. All right, cool. Well, thank you guys very much for joining. I appreciate it. So obviously, shoot me an email. I will get back to them. Probably give me till tomorrow. Would be great. But thank you guys for joining. If you're interested, of course, we'll be back. I don't remember if we're talking about passive income or ETFs next week, but I'll be back here by myself in the building with the cleaning crew. Yeah, thank you guys very much. I appreciate it.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and/or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.